Second, and then of the Harvard Kennedy School Alumni Association of Nigeria. And so on behalf of the entire membership of our association, I'm pleased to welcome our speakers, our moderator, and our esteemed audience to this third in the series of our Africa Dialogue series with the theme Reviving Nigeria's Economy. The essence of these dialogues are very, very simple. And the purpose for us is to either catalyze debate on contemporary issues of public policy or national development. And of course, in this particular instance, we recognize that scholars and indeed patriots are aligned in their concern for the state of Nigeria's economy presently. And of course, over the last 5 years, we've suffered about 2 recessions. The average growth rate of the economy over the last 5 years is estimated at about 0.3%. And and when you compare this to the potential or estimated potential growth rate of 2.7%, of course, you see that there is every reason for concern. All of these is that, there's a combined effect of both national policies, the kind of policy choices we've made as a people, and of course, COVID-19 has become, a major, there's a lot of things that have been anchored on this global pandemic. And I'm not saying this to understate the impact that it has had on global economies at all. Of course, we are contending with double-digit inflations, and people are really, really having a hard time. Unemployment is pretty high. Inflation is pretty high, estimated at nearly 20%. Unemployment combined with underemployment, again, is estimated at nearly over 50%. Our debt profile is at an all-time high, and due to government's excessive borrowing, and it is rising. It is really, really rising, because every day, every week or month, we have new demands by government on the National Assembly to approve borrowing plans. Of course, these indices are there by any standards, and of course, they're a source of concern to patriots and to economists of integrity. And so the conversation with Professor Ricardo Hausmann and Mr. Bismark Rewane is intended to really provide expert insights into these issues. Professor Hausmann is a professor of the practice of economics at the Harvard Kennedy School. He's director of the Growth Lab at the Harvard Center for International Development. And of course, Mr. Bismark Rewane is CEO of the Financial Derivatives Company, as well as an esteemed member of the Presidential Economic Advisory Council. We're confident that between these two gentlemen and our expert moderator, Michael Famaroti, Chief Economist at Stairs Data in Lagos, that between these two expert professionals, that will be able to get insight on the kinds of policies that, if adopted, is going to help Nigeria to really begin to get on the mend. So thank you very much for joining us, and please sit back and enjoy.
Hi, good morning. Thank you all for joining us today. Thank you very much for that wonderful introduction. My name is Michael Famaroti. I am co-founder and chief economist at Stairs. Stairs is an information company focused on providing bespoke research and data solutions for corporate institutions and governments in Africa. In particular, we focus on areas related to the digital economy and the features of industry. So I'll just kick off today's conversation. So Frank Wickett did a fantastic job in terms of laying out some of the key indices and numbers that are of concern. Today's conversation is about reviving Nigeria's economy. And I think for us to begin to discuss that, we should very quickly just outline the state of where things are today. I think the easiest summary is to simply say that Nigeria is at the end of the cyclical and structural economic downturn. Cyclical because in 2020, we entered our second recession in the last 5 years, triggered by COVID. Structural because when you look at Nigeria's growth over a 5-year period, the time span between 2016 and 2021 is the slowest 5-year growth period that we've had since the early 1980s. So the reality is that we are starting from zero again, and we need to revive the economy against certain key constraints. These constraints are some of the indices that were highlighted earlier, and I just want to toss in one more, which is that we're seeing a very clear divide in the underlying economy between sectors related to the digital economy and those that are not, right? So even though agriculture continues to grow in importance, it's also a very unproductive sector, right? Data from the World Bank in 2020 show that people that are working in that sector are actually more likely to be living in poverty than their peers in other sectors. So this digital divide is another constraint that we need to bear in mind as today we walk through some of the possibilities for Nigeria to revive or resuscitate its economy. Having laid that context, I am going to hand over to Professor Hausmann for him to give us a very quick run-through of his perspectives on this issue. Thank you very much, sir.
Okay, well, thank you very much for this kind invitation and this opportunity to speak to all of you. I need to be very humble because you know, giving advice left and right without knowing the context in great detail is a fool's errand. I can't say I haven't been in Nigeria. I have been, and I have fantastic memories of my trip to Nigeria. I visited Lagos, I visited Abuja, and then I did a super interesting trip from Abuja to Kano through Kaduna and through a bunch of farms that Kola Masha took me to see his Babangona initiative. And so I have vivid memories of many villages in Nigeria and the north. And in Lagos, I had the opportunity to speak to Governor Fasola and his team in those days, and to speak to, in Abuja, I spoke to Ngozi and to the governor of the central bank. And so I cannot say I'm completely ignorant of Nigeria, but that was 10 years ago, and it was in a different context. So also, I cannot say I'm completely ignorant of the challenge. I am from Venezuela, and Venezuela is also an undiversified oil exporting country, but we really have made a big mess of things. And since 2013, GDP has fallen by 80%. So, you know, I look at Nigeria with some level of envy because we have made a much, much bigger mess than the challenges that you face. So I also come with the humbleness of knowing that it could have been much worse. Now, I have developed a certain view of what the secret of growth is, and I have some views on proper macro management. Now, once upon a time, I finished, let me tell you a little bit more about myself. I finished my PhD in 1981. That was some time ago. Just in time for the 1982 Latin American debt crisis, which led to a balance of payments crisis in Venezuela in February 1983. And that started what was called in Latin America in those days, the lost decade, a period of very low growth, negative per capita growth, high inflation, multiple exchange rates, black market premia, price controls, exchange controls, import controls, We got out of that in the late 80s, early 90s. Okay. Now, it was such a problematic macro picture that I became convinced that if we solved the macro, all the other problems would go away. Now, in the 1990s, Latin America, during the 1990s, I mean, in the early 90s, I was the planning minister of Venezuela. But after being the planning minister of Venezuela, I became the chief economist of the Inter-American Development Bank, which is like the African Development Bank, but for Latin America. And during the 90s, Latin America made enormous macro progress. And the countries went from, triple-digit, four-digit inflation to single-digit low inflation. They went from bankrupt to investment grade. They did a fantastic macroeconomic turnaround. Now, the economies didn't grow that much. So when I got to Harvard in the year 2000, I was suddenly convinced that my previous belief that if you fix the macro, you fix everything, it was wrong. And that the macro is an important thing to fix, but that it's not enough, that the engines of growth have to do with other things. So I'm going to start by telling you a little bit of, the macro problems and potentially the dead-end streets that you might get into. And then I want to go into what I think is critical to growth. But as two separate things. So let me start with the macro. I think the current Nigerian situation reminds me of the Latin American 1980 situation, the current Ethiopian situation where I'm actively involved right now, and the current Venezuelan situation. That is, you get hit with a decline in the price of oil. That simultaneously lowers your availability of foreign exchange and the availability of government revenues. The government responds by imposing exchange controls, try to ration the foreign exchange, to limit the access to foreign exchange. But the government also faces a funding problem. And the funding problem is more easily solved by essentially accommodating monetary policy. This creates an incompatibility between fiscal policy, monetary policy, and exchange rate policy, which leads to dual exchange rate or multiple exchange rate regime with a black market premium between the official and the black market rate. Rationing of imports means that firms have to queue up to get foreign exchange. And without foreign exchange, they don't have the raw materials, the intermediate inputs, the spare parts, the seeds, the fertilizers, the agrochemicals to produce more. They're waiting for these things to arrive. These things get slowed down. Productivity goes down. And the activities that you wanted to stimulate, which were the ones that would generate foreign exchange that would substitute for the declining oil revenues, are taxed de facto by being given an exchange rate which is not the market clearing rate, by giving them an overvalued exchange rate. So the mix of an overvalued exchange rate, difficulty in accessing foreign exchange, and so on, makes it very difficult for potentially new exportable activities to develop, or even for potentially new import competing activities to develop more effectively. And this becomes somewhat of a dead-end street where the more you get into that dead-end street, the more you have to go back at the end because there's no exit over there. One of the additional attractions of this kind of macro setup is it allows you to have domestically very, very low interest rates, way below the inflation rate. And as a consequence, it allows the government to finance itself not only through the inflation tax, but also through financial repression. By imposing the exchange controls, you more or less sever the relationship between domestic interest rates and foreign interest rates. And through that channel, you allow the government to fund itself at negative real rates, which facilitates fiscal management. So all of these things, I mean, it's happening, as I told you before, it's happening in Ethiopia, just this, it's happening in Nigeria, as I understand it, and it's happening in Venezuela. So the only problem is that it generates short-term, it facilitates short-term macro management in some direction, but it does a lot of harm to the incentives of how you get out of these things. And you would want to get out of these things by generating more incentives for other parts of the economy to generate foreign exchange, and to do so in the most efficient way. Now, as you know, Nigeria and Venezuela have oil as their main or dominant export by a mile. And the countries probably have discussed about diversification forever, but it never happens. And we have to try to figure out, why that is. On the one hand, it's hard to diversify when you have this big monster there, this oil monster generating foreign exchange in good times, so that when the price of oil is as it is now, the foreign exchange constraint sort of like lifts somewhat magically and creates disincentives for other people to try to generate foreign exchange. But when it falls, then you don't have the industries that could have generated that foreign exchange. But on the other hand, I think that the fundamental reason why Nigeria and Venezuela don't export other things is because we don't know how to make them. We don't know how to make them competitively. We lack the know-how to make these other things competitively. I'm going to share with you for a second my screen if I can. No, I can't. Don't worry. I was just going to show, what is Nigeria and Venezuela competitive globally in, and what are other countries. So I'm now a co-host, so I now can share. Great. So let me just show you this graph. This is Nigeria's export basket. As you see, it's dominated by crude oil and natural gas. If I compare it to Venezuela's, it looks very similar. Nigeria is a country, last time I checked, I think it was 206 million people. Austria is a country of 10 million people. Let me show you Austria's export basket, right? They are producing everything, even though there are only 10 million people. If you look at a country that also speaks Spanish like Venezuela, say like Mexico, they produce a ton of other things, right? They even produce oil, but they have they produce cars, they produce computers, electronics, etc. So when you ask yourself, how did they become good at these other things? I want to say, let me stop sharing there. I want to say that this know-how, the ability to make other things, the knowledge necessary to make other things flows into countries through rather narrow channels. And we have to understand what those channels are and how those channels can be enhanced. The first channel through which it flows is migration. You cannot make watches without watchmakers, but you cannot become a watchmaker in a place that doesn't make watches. So you have this chicken and egg problem. If you want to start being good at new things, well, you cannot do things that you don't know how to do, but you don't know how to do the things you don't do. So this limits the process of diversification. So the first element that facilitates that is you just bring some watchmakers, and then you develop a watchmaking industry, and suddenly you start seeing other people being trained as watchmakers because there's already a place in which you can learn the industry. So migration is an important lever, and many countries in Africa, I haven't checked the migration policies of Nigeria, but many countries in Africa have extremely restrictive immigration policies, particularly biased against high-skilled people. I worked a lot on South Africa and on Namibia, and this is a big issue there, okay? In many countries, you have a maximum, say 10% of foreigners in a company, and you have other restrictions that come from professional exercise of, in some sense, the intellectual elite have created barriers for foreigners to compete with them. So migration is a lever that sometimes gets limited. Okay. The second, obviously, is foreign direct investment, which, by the way, needs some migration. So, these are companies that know how to do things, but they don't know if they can do them in Nigeria. Will they be able to get electricity in Nigeria? Will they be able to hire the complementary skills that they need? Will the logistics work out? Will workers be able to come in and out from their production site? Will materials be able to move? Will they be able to get imported intermediate inputs, et cetera, et cetera? So they need to figure out how to do business in Nigeria and or in any other country for that matter. And that process is a process of a little bit of providing them more information and adapting a little bit the local regulatory framework so that it makes it easier for them to think of Nigeria as a destination. Obviously, with such a large internal market in such a critical point in location in West Africa, there are many assets that that Nigeria puts on the table. And when Nigeria was growing fast during the commodity super cycle of 2004, 2014, and it was about rising Africa, etc. There was a lot of interest in Nigeria. The moment the price of oil declined, we all know what happened. The third element to accelerate growth is the diaspora. Many countries in the world, including Venezuela and Nigeria, have an interesting diaspora. The diaspora, in principle, knows two worlds. They've been exposed at other ways of doing things. They've acquired other, knowledge that they wouldn't have acquired in their home country. I mean, here we have the Harvard University alumni as a good example. So the diaspora, whether they come back or whether they stay abroad, can connect the country to knowledge, to technologies, to ways of doing things. And they naturally identify gaps because they know the world and they know they know two countries, so they can see gaps, and that gives enormous opportunities for business ideas that help diversification. Now, the final thing that I would say, and here I stop, is that a production of anything needs things that you can buy in a market, and we can discuss how to make these markets a little bit more effective, but things that you cannot buy in the market because they're public goods. So they're either provided by the government or we're screwed. These things are very, very strong complements of things that you can do on your own. You can on your own go and buy a car, but a car is not very useful if there are no roads, if there are no traffic lights, if there are no traffic rules, and if there's no rule enforcement by traffic police, etc. So the accumulation of things that you can do on your own is strongly encouraged by the availability of those things that it is the responsibility of governments to make, right? And there, I was really astounded at the very, very low levels of taxation in Nigeria. Taxation inclusive of oil for the year 2019-2020 was less than 9% of GDP, and overall government spending was something like 12% of GDP. This is amazingly low, and I think it's a structural problem that is serious, because it means that the government cannot complement society in the things that only governments can do for societies. So I think that that's another element that is critically important in a growth strategy. So let me stop there. I think I went way too long, but let me again express my happiness of having been invited to this conversation. I'm looking forward to all the things I'm going to learn.
Thank you very much, Professor. That was a fantastic deep dive. I am very glad that you started the conversation really by just reminding everybody about context, that Nigeria's economic woes must be interpreted against wider backdrop of similarities elsewhere. There is a danger of Nigeria exceptionalism that we are still struggling to get past as a country. And I think just highlighting how countries like Ethiopia and Venezuela, both now and in the future, and in the past, have grappled with similar issues. I think that provides us a bit of a foundation for us to go deeper. I will hand over to Mr. Rewane shortly, and I'm looking forward to him providing a bit more of the local nuance to this conversation, as we also get the opportunity to evaluate some of the growth drivers that Professor Hausmann had indicated in his own presentation. So, Mr. Rewane, the floor is yours.
Thank you, Michael. I'm about to share my screen. I think we already shared, actually. So, okay. Can you see the screen? Now, thank you very much. And thank you, Professor Ricardo, for your perspective. I think you actually resonate with us in the sense of what we do know and what we are trying to accomplish by reviving or resuscitating or actually jump-starting the Nigerian economy. So I start off by saying, and I have only about 10 minutes, the word reviving an economy reviving means to restore life or consciousness. It presumes that the economy is either dead or unconscious, which may not be the case, but there are varied views about the Nigerian economy today. Some say it's recovering, some say it's comatose, some say it's fragile, some say it's failing, or some have said a little bit of all of the above. Now, one other thing that Michael talked about initially was the policies that at the end of this period, we'll look at what policies will get us out of where we are. But I'd like to add to that policies and attitude, because we have policies, we have laws, we have rules, we have guidelines, but we don't seem to be going nowhere because of the attitude. So the mental adjustment is always more difficult than the fiscal adjustment, from what I can see. So what have we done? There's a slow and reluctant shift from imperfect markets to perfect markets. It started an economy which was totally government controlled, both politically and economically and socially, media, everything. But over time, we've moved from state-owned monopolies all the way to some kind of oligopolies, cartels, and then we're moving towards imperfect competition, towards perfect competition. We've gone through a period of state-owned monopolies. We went through civil war, we went through indigenization, which is sole ownership, privatization of state-owned enterprises, liberalization of sectors, and adoption of exchange rate reforms, albeit slowly, reluctantly, and at times inadequately. For sake of context, you have different models for growth. You have the export-led, which is Germany, Japan. You have the government-led investment, Rwanda. You have the consumption-led and export-led, which is China and India. And then, of course, we have what Nigeria, in theory, says an investment-led strategy, but in practice, it is more dominated by government and fiscal dominance. So basically, what do you do when you have an investment-led strategy? You should have a high savings ratio, optimal capital utilization, an efficient multiplier, unlocking of idle resources, open the economy rather than a closed economy. These are the things that Nigerian government says they want to do. These are the things that the Nigerian policymakers try to do, but in reality, we face uphill tasks. The conflict between national interest and enlightened self-interest continues to impede growth, and you talked about growth drivers. But what are we seeing? We're seeing economy growing as fast as we can be, with negative growth, recession. But before this last recession, Nigeria already had pre-existing conditions of structural difficulties, recessionary gap in terms of potential GDP growing faster than real GDP. We also have total factor productivity, which was negative. Now, so what the thing to do is what to do next. So we have multiple taxes, we have policies, we know that, and profit. But this chart tells you about countries that have high savings rates and necessarily at times low inflation rate and high GDP rate, mainly Macau, Singapore, Ireland, Singapore. And so, yes, there's a link between policies and attitude as well, and outcomes. 5 top recipients of foreign direct investment. I think Ricardo mentioned this. In Africa, we have the 5 top, and their ratings are here. You have Egypt, Democratic Republic of Congo, South Africa, Nigeria, and Ethiopia. So even though Nigeria is the largest economy in Africa, it has, I think, the largest population, but it's only the 4th largest recipient and very pale compared to over $1.3 trillion of global investment flows. Nigeria can boast of only $4 billion. So gross savings rate, you can see that. And so we know this. So in the last decade, what have we done? We've gone from elections in 2011 to elections in 1998, all the way to where we are now. So we've had growth of 4.2% in 2012. We've had the Boko Haram challenge, we've had oil boom, so the story is clear and it's well documented. But what has happened is that we've had, every 4.3 years, we've had a recession. And every time we had inadequate dose, misdiagnosis, and at times we have failed to recover. The recovery has not been as strong as the recoveries, external recoveries, and also as may be desired. To actually achieve the kind of growth that will bring unemployment down, we need to be going about 2% above the potential growth rate, and we are nowhere near that. So we need to be going at about 8, 9, 10%, but we are growing. This year, we'll be lucky to grow at 2%. So what have we done? Ricardo mentioned the fact about, you have the bunker mentality. You need to, we have limited resources and infinite needs, so we need to ration. And so we have the currency adjustment process. We've signed the African Continental Free Trade Agreement, which means that you are opening up your country to markets. And if you open up your country to markets and you are not competitive in terms of your pricing, you are only going to actually entrench some of the distortions. So the truth is that external momentum is driving policy change and attitudes in Nigeria more than the internal commitment to do the same. So this is where we are, economic indicators then and now. In 2011, we grew at about 7.6%. 2021, we are growing at about 2% at best, or 1.5%. The GDP, even though it has been rebased, then it was rebased some time ago, $405 billion, now about $432 billion. We're going to do that. The income per capita, which means that per head, was $2,660 per head. It's now $2,100 because the population growth rate is faster than the GDP growth rate. Unemployment is another story altogether. It's about 33.3%. And inflation has gone up from 2011 to now from 10% to 17%. Life expectancy, on the other hand, has actually gone up from 51.35 to about 55. And the external reserves has increased from 32 to 36. But one other variable is here is the external debt in dollar terms. It was 5.63 in 2011. It's now 32.86. And by the time you had the Eurobond, you would have it at about almost equal, or if not higher than the external reserves. What do we have? We have a balance of trade. We have imports at 64 and exports at 8. So there's a balance of trade supply, but in reality, and we have an exchange rate that was, now we have a balance of trade deficit. The exchange rate in 2011 was 156 naira to $1. Now in the parallel market is 580 naira to $1. So, did we learn from the lessons from the problems of the past? Not really. And so we've had 2 recessions, exogenous factors, oil price shocks, COVID pandemic, and other factors were that there was structural deficiencies in the economy. Now, what do we do next? What can Nigeria do differently? Policy options, choice, and impact. Like they said, doing the same thing and expecting different outcomes is insanity. So what are we going to do? First and foremost, everybody says infrastructure. The gap is there. We don't have that kind of money. So we need to select the things that we are going to invest in, like tolling of roads and concessioning, something that we'll do differently, so what do you do with tolling of roads and concessioning means that you reduce the cost of maintenance of the roads immediately. And the government is trying to do that, but you have to do it aggressively. We have 197,000 kilometers of paved roads, badly maintained. So you take the key roads that link the major markets, concession them, and then the government doesn't have to pay any maintenance for those. You take the airports, take the seaports, concession all of those, and therefore you immediately put those things in the market and be run. The roads will last longer, there will be lower accidents, longer life expectancy, and also this will coincide also with pipelines, so that you can, because the wear and tear on the roads is even worse because of the trucks and trailers and going on. If you push these things through the pipes, you will see that the wear and tear will reduce. And so that's one major thing. The second major thing is, how do we build gross fixed capital and investment? What incentives do we have to give investors? I think Ricardo talked about that, and we can outline them very clearly. Currency compatibility, basically, what the currency you have to head towards currency compatibility, so that you have a current account convertibility and then capital account convertibility, which is about a 5-year differential. To do that, you need to have a clear strategy on how to maintain competitiveness between you and your major trading partners. Right now, that's a work in progress, but we have to do that. And that will bring consistency between the external economy and the domestic economy. Of course, you can't make omelette without breaking eggs. So what are the risks that we run? The risks are that today, just limping along, is the economy going to be able to limp from now till the next administration? The answer is not likely. So you need to do some things now, but doing those things mean that are politically unpalatable. So we have to think about that. The risk that if there's a default on sovereign debt, either by a Nigerian government or a Nigerian major issuer like a bank, it could come back to haunt us. Political fallout and conflict within. Those are risks that we have to. Then the fact that oil, the price of oil could drop precipitously and then we'll have no fallback. And also the fact that interest rates rise in the Eurobond market, which will actually make our debt. So in the end, let me just finish a summary and conclusion. We want to attain sustainable and accelerated growth. We have to adopt an investment-led strategy. As I said, concession the roads, airports, and seaports, some of those big ones, so that you can use the money that you are going to use to maintain that to do other things for the people, for health, education, okay? Remove the subsidies on the petroleum products in a phased-out manner. Have the attitude of an open economy rather than a closed economy. Adopt a convertible currency, and of course, we say remove subsidies. If all of this has happened, then you'll probably be able to get new investments and the investment-led strategy, which will lead to faster, sustainable growth, will be within shouting distance. Thank you very much, ladies and gentlemen.
Thank you very much, Mr. Rewane, for that presentation. Very nice and succinct, and I think gets us into the panel discussion quite nicely, particularly in terms of laying context of how we got here through the democratic era, through COVID, and also what are some of the key paths outwards. Very interesting to note as well the consistencies in terms of focusing on investment-led approach, because that's something that, again, Professor Hausmann also highlighted in his discussion. So I'll just kick off the panel discussion, and I know that there's some questions coming in, and subsequently we'll begin to deal with those questions from the general audience. The first question, though, that I have is actually for Professor. You spoke about some of the key channels for know-how in terms of migration, FDI, and the diaspora for countries like Nigeria. I think one thing that stands out from those is how they're very much the tenets of our open economy. Given some of the realities on the ground, what we've observed over the last half decade is the tendency for policy in Nigeria to be a bit more insular in its design. So one of the things that I wanted to follow up on is what are the potential paths for a country like Nigeria that may not be as willing to leverage some of the more outward-facing channels of know-how, like migration, like FDI, and so on. Just want to confirm that you can hear me.
No, that's a very good question. Well, I think COVID-19 is definitely having a lot of impacts on societies, but one of the effects is that it has shut down international travel, by over 80%. I published a paper last year in Nature Human Behavior that was done with data pre-COVID, highlighting the importance of international business travel for the growth of productivity, employment, and exports. And I can only imagine that this cut in business travel is going to have deleterious effects in the diffusion of technology. Because the effects we estimated were relatively large. And so I wouldn't be surprised if things are made in some dimensions harder than before. Essentially, people, you might ask yourself, why the hell do firms spend money sending businessmen around the world if they could just have a conversation by Zoom, by email, by phone, or whatever? But obviously, history suggests that there's some benefits of moving the brains, because you're not just moving information, you're moving sort of like the CPU, the machine that processes the information. So anyway, but that is what it is. But one important thing we learned from COVID is that things that we used to do at work can be done from home. But anything that can be done from home can be done from abroad. And what we're seeing is a big increase in telework. So while everybody's becoming more protectionist and the US doesn't want to talk about any new trade deals and so on, in fact, I mean, the only important trade deal recently has been the African free trade agreement. But as the world has become a little bit more protectionist, actually, it has become more open in terms of telework. Some people call it telemigration. So if the cost of living is much cheaper in Lagos than in, I don't know, in London, and if you can sell your services in London through Zoom, or remotely, then you have a double whammy. You have sort of like the same income but a much lower cost of living, and it can create very large incentives for people to engage internationally. You have the fortune that you're more or less in the same time zone as Europe, and you speak English. So that opens up a set of connections and doors. There are even some platforms, online platforms to sell tasks. There's this one called Upwork. For IT, there's one called Torre. This is in some ways a way of integrating the Nigerian labor market to a global labor market through international trade in tasks. And every time you do something, you learn how to do it better. So it's a path towards the accumulation of know-how also without leaving your home. So I should have mentioned it. I think it's an important thing that we should try to make the most of it. You have to play with the cards you are dealt with, and this is one of the cards that has been dealt to us. Yeah, let me stop there.
Thank you very much, Professor, for that answer. Actually diving further into this idea of an investment-led approach to reviving Nigeria's economy, I think one of the themes that has already come is the Africa Free Trade Agreement. Naturally, there is a bit of comment about the potential or the actual outcomes that will come out of that for Nigeria. But when we're wearing an investment-led hat, the appeal of that African market size and so on is quite attractive. And what I wanted to get from the panelists, starting from Mr. Rewane, is a perspective on, in the medium term, right? What are the ways that Nigeria, be it policymakers or corporates, what are the ways that Nigerian stakeholders can leverage that trade agreements or walk in the direction where we're in a position to do so, to boost our investment attractiveness over the next 10 years? So you just pick that up with you, Mr. Rewane.
Can you come again? You said attractiveness for, I wasn't hearing you very clearly. The attractiveness for foreign investment in terms of where to invest, what sector to invest in, and so that will have a multiplier effect. Was that what you said?
So the question was, looking at the AFCFTA, what are the ways that we can begin to leverage that or put ourselves in a position where we can probably reap the benefits in terms of boosting our investment attractiveness?
Okay, let me try to address it. The first thing about the AFCTA is that it makes a bigger market. So you talk about the economies of scale, but the flip side of the economies of scale means you have to now specialize on those things. You have a comparative advantage. So for Nigeria, you have, again, policies and attitudes. You have to now decide those things that you will not compete in, and the things that you're going to focus on. So you can't produce everything. The import substitution strategy falls flat on its face there because your markets are open, and then your export-led strategy complements the investment. Therefore, if you are exporting cement, you're exporting some solid minerals. you are exporting some light manufactured goods, food and beverage and all of that, then you can have an advantage there. Where a Nestle or a Diageo or Coca-Cola decides to make its hub of production in Nigeria for the rest of West Africa, whilst at the same time some inputs that were coming from, which were expensive, could come from other West African countries. So that's number one. Number two is that the agreement calls for removal or reduction of non-tariff barriers. So we have to implement that. We cannot on one hand implementing that and at the same time restricting foreign exchange. So I think it goes together, but we have to, and you have to have convertible, more or less convertible currency process. And the African Continental Free Trade Agreement also is rides on the back of what we call the regional integration of ECOWAS, where you have regional convergence criteria. So your inflation rate, your fiscal deficit to GDP ratio has to meet the norms of the regional convergence criteria at the same time. So, and then you have the eco currency coming up in 2027. So when you put all of these things together, you have to have a number of policies that leads to achieving that goal in 2027. The ratification of the African Continental Free Trade Agreement, reaping the benefits of scale economies, deciding on things that you cannot compete in, which you have to give up. And then all of this will be part of the growth strategy. So the investments come in to pursue things where you can export. So it will be a growth, investment-led growth strategy supported by an export-led strategy where in the areas that you have comparative advantage.
Thank you very much, sir. And just flipping that same question to you, Professor, given your perspectives against studying development of emerging markets over the last few decades, you look at an agreement like the AFCFTA and countries like Nigeria with their particular context and challenges. What are the key ways outside currency normalization, for example, what are the key ways you would be advising a country like Nigeria to leverage the AFCFTA in the very short term? I think the professor is still muted.
Okay, let me say a few things about this. The first is that there's a really, really, really bad, dangerous idea that is very popular in Africa. And that's the idea that it is really very important that you add value to your raw materials, beneficiation, and that you start thinking about your future from the lens of beneficiation, the lens of adding value to your raw materials. This is a super castrating idea. It's an amazingly limiting idea that prevents you to think of all the possibilities you have ahead of you. All production is about adding value to raw materials. All production is about you get some inputs and you do something and the output is worth more than the input. So you add value to inputs. The operational word is your raw materials. Why does it have to be with your raw materials? All raw materials are as far as the nearest port, and you happen to have a very good port in Lagos. So you can add value to any raw materials, not to your raw materials. And most products don't have a single raw material that is key for them. One of the success stories in Nigeria is Nollywood. It's not defined by any raw material. But if you were to ask, here, my cell phone, what is a key raw material in cell phones? You need to be able to integrate so that you can access any raw material and give your producers the possibility to add value to any raw material. So I would suggest that once you take that perspective, many, many new things open up that would otherwise not have been possible. So if you look, I don't see why a strategy like Vietnam's is not possible in Africa. I mean, Vietnam was much, much poorer than Nigeria back in 1988, where my guess is that everybody in the call was already born and kicking in 1988, so it's not that long ago. But, you know, there's nothing except for coffee or something which is minuscule in their export basket. There's nothing about their raw materials that are key. So, you know, the free trade agreement in Africa can increase the access of Nigerian producers to a larger swath of raw materials and not just the ones that are locally available. The second idea I would mention is that you tend to export more basic products to richer countries and more complex products to countries that have a more similar level of income than you have. And because you have a very large domestic market, it is a good place for multinationals to base their strategy, as was mentioned, you know, by Dr. Isishe, that you would be a good base to supply for Africa a bunch of things that do not necessarily rely on your raw materials, but rely on your ability to do things. And that's, in my mind, that is the key focus. You want to add not value to your raw materials, you want to add capabilities to your capabilities, and then give your producers the possibility to add value to any raw material. I think that the food industry, the drug industry, but all the other industries will be, will need to look at Nigeria in the context of a broader market in the region. And what will be important is the ability for producers in Nigeria to access any input and to access any market, and then to attract the missing skills to the country, so that companies know that if there is some skill missing in the country, it's not the end of the world. They can bring it from somewhere else. And that is why the European Union not only has freedom of movement of goods, it also has freedom of movement of people. And I think it's an important lever, because in the end, know-how exists only in brains, moves with enormous difficulty from brain to brain, and it is much, much easier to move brains than it is to move know-how into brains. In any case, it's much quicker. So that's why I'm so adamant about making it clear that you want to have this openness to brains.
Thank you very much, sir. I think the emphasis on know-how is taking, and I'm sure the audience has picked up on that. I also especially like the reminder that it's important that we plug into global supply chains for us to move along production value chain from less efficient to higher, to more efficient stages like production, processing, and so on. I think it's a good time for us to turn to some of the constraints that we've highlighted in charting this part. And the first that I want to talk about is Nigeria's debt situation. I think the latest data from the budget office show that for 2020, for every naira that was spent for every naira that flew into the government budget, about 98 kobo was spent on debt servicing, right? And then a big chunk of that comes from the reality that the Central Bank of Nigeria has been financing, which is something that Professor highlighted is a natural danger when you're in this sort of situation. So what I wanted to get from our panelists is given the peculiar situation that Nigeria is in, with its debt profile and its liquidity challenges in particular, how do we begin to unwind this debt situation to get to a place where government is unconstrained to interfere in the economy, to intervene in the economy? So perhaps Mr. Rewane, you can help us out with that first.
Okay, let me say something. One, yes, it is true that the debt profile has been growing at a very rapid rate. It is true that debt service expenses, overhead expenses and salaries take about 145% of our independent revenue. It is true that the contractual and non-contractual debt is about 2 or 3 times our external reserves. But at the same time, the debt profile is not consistent with factor productivity. In other words, some of the debt is being used for consumption or to refinance stranded assets. And therefore, while your debt profile is increasing, your productivity rate is actually flat or declining. So that's a recipe for chaos down the road. And intergenerational debt servicing is also growing at rate. And all of this debt service you're talking about is at a time of artificially low interest rates domestically and quantitative easing internationally. So what environment are we going into? We are going to a normalization of monetary policy globally. And because we are borrowing from the international community, we have to now begin to make our domestic interest rates reflective of the inflationary environment. Therefore, we could be heading towards a fiscal cliff. How do you get out of fiscal cliff? 1, revenue. 2, restructuring. But the good news is that the ways and means advances is not being financed for free anymore. The Central Bank of Nigeria is charging the Ministry of Finance and the Budget Office 2%, a rate of interest 2% above the monetary policy rate, which is 13.5%. And if you look at the yield curve for 7-year paper, you'll find that it is even easier and cheaper for the federal government to securitize that debt that it has with the central bank than to continue to fund it from the central bank's balance sheet. And it will also help to mobilize institutional funds. So essentially, the truth is that there is a debt burden, there's a debt service burden, there's a nominal debt growth, which could become unbearable. And there's also a productivity issue because it depends on what you use the debt for. And if that debt is being used to fund subsidies on petroleum products and all the other things, then you are actually heading for a fiscal chaos. Is the government aware of this? Yes, the government is aware of this. The policymakers are aware of it, yes. And steps are being taken, 1, to normalize monetary policy rather than the unorthodox monetary policy. The fiscal restructuring of debt and refinancing of this debt is being pursued right now. And so I do not think that the macro picture and the fiscal picture is going to push us into a crisis situation. It's going to be corrected, but it will be corrected with some pain. Again, like I said at the beginning, the mental adjustment, which is the attitudinal adjustment, is more painful than the fiscal adjustment. And that change of mindset is where we are at this point in time.
Thank you very much, sir. Professor, just again, flipping that question to you, because you started your presentation with a very short perspective on Venezuela, and I believe that one of the challenges that the country faced at the time was very high government spending ratio compared to GDP. There were lots of subsidies that were issued and so on. So that debts and government financing situation became a real constraint for Venezuela. Having watched that process for multiple countries now, what are the key pointers that you would be giving to policymakers in Nigeria to ensure that you can avoid going down a similar path?
Well, let me say that several things. I mean, we had the lowest gasoline price, petrol price in the world, and now with high inflation and with nominally fixed price of petrol, then the subsidy increases every day with inflation, right? So there's a lot of fiscal resources were wasted in essentially making transfers and subsidies and financing consumption instead of public goods. And I think that's definitely one element that you want to avoid. I am really taken aback by how low is our tax revenues in Nigeria. I think that there is no future for Nigeria without a government that is able to mobilize significantly more tax revenues. I understand a little bit, way too little, of the history of Nigeria. You are a culturally very diverse society with houses in the north, the Yoruba, the Igbos, etc. You're diverse in languages, you're diverse in religions. There's a study recently published in the American Economic Review on of all one of the top 5 journals in economics that shows that the impact that the World Cup has on national identity in Nigeria. That it's the only, it's a place where people start thinking of themselves as Nigerian and rooting for the national team. I think those sentiments are fundamental to sustain a tax effort, because it's the idea that we're building a nation. We're building a nation state that has to have the resources to protect us, and you're paying the cost of not having the capacity to protect yourselves. That has the capacity to provide the basic infrastructure, and in a world in which so much can be done through the internet. Still, electricity penetration is only about 60% of the population, and that's electricity. It's not a very recent technology. So I think definitely whatever fiscal adjustment you want to do, it's an adjustment that has to have a very, very significant revenue component. And how do you charge? How do you collect revenues in a low-income country with high poverty rates? Well, that's a challenge. That's why oil can sometimes be a blessing, because it allows you to build a much more powerful state than your capacity to tax the general population. That obviously can have all sorts of negative elements, but it's very important that the resources that you do get allocated to the buildup of this state capacity to provide the necessary public goods. That will make society more productive. In that sense, I would say, just looking at the numbers, Nigeria has a relatively high private savings rate. It has a negative public savings rate, and that's very unusual. A negative public savings rate. If an investment-led strategy has to have some contribution of public savings, but here you have negative public savings. That's a very unusual thing, and I think that's a reflection of this very, very low tax effort in spite of oil. So I think that has to be put on the agenda. Now the problem with debt is that once you get into problems, it takes years to fix them, and it has enormous costs to fix them. The world is becoming a little bit better at debt restructuring, but still, the debt restructurings, generate a slowdown of capital inflows until the issues are resolved, and so on. The final thing I want to say is that because you have fiscal problems, you use financial repression as a form of taxation. You're de facto using financial repression as a form of taxation. And it's a fairly progressive form of taxation because you're taxing the savings of the relatively rich. And so it's hard to give up. So if you were to unify the exchange rate and etc., interest rates will have to be competitive. You cannot just live off of a mousetrap currency, and so on. And that makes the fiscal transition even harder. So all of that means that I would put tax revenue mobilization at the very, very top. And I would think very hard of ways in which you can make it as progressive as possible in that context. And oftentimes, it has been very popular to lower tax rates on capital income in the developing world. So lower corporate tax rates and lower personal income taxes that originate from capital income. In many countries that I have seen, the de facto tax rate on capital income is fairly low. And so the government relies on taxing formal labor income because it's much easier to tax. And that is a recipe for increased informality and for, an unsustainable politics. So I would explore all the possibilities of raising income from capital revenues, from capital income, in a way that it doesn't scare away too much investment. But the thing is that what scares out investment is a broken government, a government that cannot pay its bills, and a government that cannot have a single exchange rate, and a government that cannot create the basic infrastructure. So I would very much look into the contribution that taxation on capital income can make to the overall revenues of the state.
Thank you very much, Professor. Just a final question actually on taxation, because from my experience so far, Nigeria's low tax to GDP ratio, which I think now is around 67%, hasn't necessarily been born out of a lack of effort, right? So in the last 5-10 years, we've seen policies from the VADE scheme, which didn't work out very well, to increases in VAT to 7.5%, and also rollout of excise duties on tobacco, cigarettes, and so on. So there have been efforts to try and boost tax revenues, also focusing on technology, trying to bring in informal small businesses into the tax net and so on. Overall, however, we haven't really seen much improvement there. So, Mr. Rewane, I actually just wanted to get your perspective very quickly on, in terms of boosting Nigeria's tax revenues from where they are now, what are the key ways you would be pushing for us to address that over the next 5-10 years?
Okay, let me start off. I agree with Ricardo that our tax collection strategy is not optimal. But if you look at the way the informal and informal economy, going for tax revenues, progressive taxes are direct taxes, which are difficult to administer, where the database and where incomes are not easily identifiable. So we are left, the most efficient way of raising revenues is the indirect and benefit approach. the thing about the indirect and benefit approach to tax is that the tax that Aliko Dangote pays for petrol at the station is what my driver will pay at the same time. They are regressive, so it doesn't discriminate in favor of the poor. It discriminates in favor of the rich. But at the end of the day, you need to generate revenue. So Nigeria is caught in between having progressive taxes, which tax the rich who are invisible, whom nobody can see, and collecting revenue from the poor who have to pay it on the benefit approach. So it's somewhere in the middle. We have to look for that. And therefore, it depends. The second thing is, what do you do with the tax revenues you've collected? The people in Nigeria are very, very skeptical about paying taxes because they do not see the outcome. They do not believe that their monies are not being stolen. And therefore, there's a credibility gap between different administrations. And therefore, it makes the whole tax mobilization strategy difficult to implement. But also, we need to use digital methods and what I call the internet as a very efficient way of collecting taxes, increasing the tax, spreading the tax net, but also reducing the effective tax rate. We also have the tax for road swaps, where MTN is building a road between Onitsha and Enugu. Dangote is building a road between the port and Bagada. That conversion of tax to assets based on a valuation which people have to look at. This makes the whole tax strategy of Nigeria is something, it's a work in progress. It's very difficult. There's not a silver bullet that will address it.
Okay, thank you very much, sir. Thank you very much, Mr. Rawani. Yes, sir. So in the interest of time, I think it's probably a good idea for us to go on to questions. I know they've been piling up in the chat box. So I'm just going to go through and ask the questions to the relevant parties. So I think the first question here is, I think this is for Professor. So in comparison with the Venezuelan economy, you mentioned that the Venezuelan economy lowered their interest rates in spite of the high inflation rates. Would you advise Nigeria to toe the same line of policy? So I think this is a question to Professor. I'm not sure if the person asking captured exactly what you mentioned about interest rates in Venezuela. So perhaps you can just give a refresher there and clarify this. Thank you.
Prof, you're muted. No, I think the prof is muted.
Unmute. Okay. Now I'm yeah. So no, exactly. I think the dead end street I spoke about at the beginning starts with you imposing exchange controls and then exploiting the exchange controls to have a very, very lax monetary policy that keeps domestic interest rates way below, what's called, the uncovered interest parity. The interest rate in Naira should be similar to the interest rate in dollars plus the expected depreciation of the Naira. And if you impose exchange controls, and people cannot get the money out, they can only pressure the black market rate up, but they cannot get in an aggregate, they cannot get the money out. So that leads to a very low domestic interest rate. And that enhances all the distortions of an overvalued official rate, incentives to over invoice your imports, and then consequently infinite demand for official dollars, and then rationing of the official dollars, and then long queues to access those dollars and a decline in productivity because so it gives you all of this these very, very negative impacts on the economy. And you feel you cannot get out of it because the day you get out of it, you have to pay much more interest on your public debt, and you don't have the money to do that. So you would have to do it through more inflation and so on. So it gets you into this dead end street. So I think of it as, as a drug. It's a drug. You get addicted to it and you cannot kick it. And so I would advise to get out of it sooner rather than later, and maybe to exploit the fact that the price of oil is so much higher now, that there are some smaller pressures on the fiscal. This is not a bad time to think of a program. I mean, it has to be compatible with the electoral cycle and so on, but there is because of the improvements in your terms of trade, you may have degrees of freedom to improve on the structural elements of your current macro strategy.
Thank you very much, Professor. I definitely agree that it's a drug, and once you get hooked on the high, it's very difficult to be weaned off it. Just turning to the audience, I know there are a few people with their hands up. So with permission and assistance from the technical crew, can we get a question from Alero, who has had their hands up for a while? Can someone unmute the mic for that person, please?
Hello, Togo.
Okay, while we wait for that to happen, I'll just go back to one of the questions from the question list. Part of the chat. Okay. Hi, Alera. Can you speak?
Sorry, I didn't mean for my hand to be up. My apology. It's been an amazing webinar. I've thoroughly enjoyed it. Thank you so much to both speakers. Excellent. Thank you.
All right. Thank you very much for that feedback. So just going back to one of the discussions that we're having about an investment, or export-led approach. One of the questions that popped up in the chat box is whether Nigerian faces a choice between a services-led economy, an industrial manufacturing-led economy, and I will now add, a digital-led economy. Right? Is this a choice that needs to be made? And if so, what are the criteria that you are looking for in terms of nudging us in that direction? So this is a question for Mr. Rewane and Professor Hausmann.
Can I take a crack at it? I don't think it's not a binary choice. It's definitely not it's not a dilemma. It's all of the above. And it depends on one combination. I think the digital revolution actually complements both the export-led strategy as well as the investment-led strategy. And I think that, like the professor said, the thing about interest rates, artificially low interest rate, that once you lower interest rates, you reduce the marginal propensity to save, and by implication, increase the marginal propensity to consume or for capital flight. And that reduces the capital stock and leads to low productivity and low competitiveness. So like you said earlier, it's a drug addiction, which Nigeria has already started getting high on it. And to a large extent, we need to get into rehab very soon. And I mean it that we need to get into rehab very soon, especially in the policymaking area. We also need to accept that you can't make omelette without breaking eggs. We need to give up some things. So one of the things we're going to give up the question of the things that we can't afford. So and the price mechanism of the exchange rate, the new exchange rate when it comes in, will make you drop those things and buy those things or import those things that are affordable, but also make you export more of those things that will make you earn and diversify your economy. So the higher interest rates closer to inflation the competitive exchange rate would actually be an inducement for export diversification. And that means that the economy will be in a kind of dynamic equilibrium, in which case almost all the parts, rather than pursuing the partial equilibrium approach that we are approaching right now. Thank you.
Thank you very much, sir. Professor?
I very much agree with Dr. Rewane's response. I think you are a big country. You are a big country, and you have and you need jobs for the people you have, and not all of them can be employed in the service sector. The service sector tends to be more skill intensive in many areas. It's very important that you focus. I mean, there is no future for Nigeria without a major increase in non-oil exports. I mean, we haven't talked about global warming, green growth, etc. And you know, right now, oil is your main export, and I don't know what will be the demand for oil in the 2030s. So it's very important that, and right now, oil is not generating, oil is not big. It's the biggest thing you have, but it's very small. You're producing as much oil as Norway, which is a country of 4 million people. Okay, so you have 1/50th of the oil production per capita of Norway. So your oil production is very, very small, and in per capita terms has been falling forever, for a very long time. It cannot sustain the growth of the rest of the economy. You need to find other sources of foreign exchange. And here people often confuse something that is attributed to my namesake, David Ricardo, that countries should specialize. I want to, so should I specialize in services, or should I specialize in industry, etc.? I think that individuals specialize, firms specialize, but as individuals specialize and firms specialize, the city, let alone the country, diversifies. Specialization and diversification are two sides of the same coin. If I go to a rural medical facility, I will find a general practitioner who does a narrow set of services. If I go to a major city hospital, that hospital will produce a much broader set of services. But the reason why they produce a much broader set of services is because the doctors have specialized. So specialization of the doctor breeds diversification of the hospital. So I think that Nigerians have to specialize, but in the process of Nigerians specializing, Nigeria will diversify. And it has to diversify into anything it can, into the whole agro industry, food chain, and non-food agriculture. It has to go into all the other, industrial value chains, but all the service chains. I mentioned before Nollywood. And like that, there's going to be many things that are increasingly, worldwide, services are over 65% of employment. So it's going to be a fundamental source of growth going forward. And so it's going to be part of your strategy, but you shouldn't walk away, especially in a country as diverse as you and as large as you. You want to use everybody's willingness to work in the way that it honors their effort by making it as productive as possible.
Thank you very much, sir. Thank you very much, Professor and Mr. Rewane. This has been fantastic. Just before we close, just have a question that has lingered on the chat as well, and I'll just add to it. So one of the participants raised the issue of what role will be played by local investment and local investors. We spoke about an investment-led approach, and I think generally we've looked at external investment to support that. I guess question there is there a bias in your mind in terms of where investment should come from, and are the conditions needed to promote the different kinds sufficiently different for us to change our strategy, or we can essentially treat investors as a more homogeneous group that perhaps has been suggested in the past?
When I use the word investment, I'm talking about total investment, both domestic, international, diaspora investment, to a limited extent for portfolio investment. So I'm using investment in its generic form. So what is not consumed is saved. What is saved is invested. But the point that with your exchange rate the way it is, there is an incentive for capital flight. So rather than invest in a market where the prices are going faster than the income growth rate, your domestic investors have an incentive to buy dollars and take it out. This is what Ricardo was talking about. So I think that, to clarify, I mean, when I talk about investment, I'm talking about all investments, and mainly domestic. In any case, international investors will not come to your country if domestic investors are not investing. So the sweetness of the pudding is the eating of your people there. So that's, I wanted to make that clarification. The investment-led strategy is all, both indigenous and international. Thank you.
Thank you very much, Mr. Rewane. And before I hand over to Mr. Frankwicke, I wanted to see if any of the panelists had any final comments or words that they wanted to leave the audience with.
Yeah, okay. I want to say something about the focus on investment. I want to make two distinctions. The first distinction is, are you looking for money or are you looking for capabilities? So when you think of foreign direct investment, are you thinking about the money that they will bring in, or are you thinking about the capabilities that they will bring in? Because if you're thinking of the capabilities that they will bring in, one thing that is increasingly happening in middle-income countries is that the large domestic firms realize that they don't know how to do something, so they go out in the world and they acquire a company that knows how to do the things they don't know how to do and integrate them into their network. So that in that case, the money is going out, but the capability is coming in, right? So I think the first distinction I would like to separate is between capabilities and money. When the Chinese invest in US government bonds, they're just sending money. They're not sending any additional capability, and anybody can buy US treasuries. But when you're talking about an investment that is going to bring an organizational capability, a technological capability, a relational capability, that is able to produce things that you wouldn't otherwise produce if they gave the money to you, then you're talking about something else. And I would put my emphasis is always on this attraction of these capabilities, okay? And the second thing I want to make, distinction I would like to make, is to ask yourself the following question. Where is the constraint? Is it that I have many investment opportunities, but not enough money to execute them? Or I have very few investment opportunities and a plethora of money that doesn't know where to go, okay? And these things are going to change dynamically over the cycle and different macroeconomic contexts, and some countries might be bumping against one constraint vis-a-vis the other. But in general, my impression is that if you work on attracting the real or making yourself attractive to the people who are going to bring in the capabilities, the money will appear. If you focus on bringing in the money, the capabilities will not appear. So that's why I'm so obsessed about this idea of capabilities and know-how and so on, and getting the ecosystem so that to work, because if that works, then investment effort will pay off and people are not dumb. They will, the money will appear, but the other way around, it doesn't.
Thank you very much, sir.
My final comment is very short. Saudi Arabia exports $145 billion worth of oil a year, but exports chemicals worth about $45 billion a year. Nigeria exports no chemicals whatsoever. Of the top 20 chemical companies in the world, Dow Chemical, not one of them is operating in Nigeria. 11 of those companies are operating in the Middle East. So what do we need to do? As the dying days of oil over the next 10, 15 years, we need to now begin to extract maximum value from oil and the oil-related products, chemicals, petrochemicals, and so on and so forth. So we need to, whilst we are nurturing the golden goose, we need to extract maximum value before it becomes a dinosaur. I think that's important. And also convert the revenues, that the monies we have quickly, into investments and also capabilities that maybe Ricardo was talking about. Thank you very much.
Thank you very much.
That's an example of adding value to your raw materials that I disagree with. These chemical industries, SABIC and in Saudi Arabia, it's amazingly capital intensive. It was justified maybe in the world in which natural gas was being vented, so that the cost of that raw material was zero. The opportunity cost of that raw material was zero. And in a situation in which Saudi Arabia didn't know what to do with the excess money they had, and they were circulating petrodollars. But it's a super capital intensive industry. The raw material, the only advantage you supposedly have is the local availability of your raw material, but the raw material has an opportunity cost of being exported. And it's not obvious that it's your best investment. I would guess that given the low capital intensity of the economy as a whole, and given that if you have natural gas, now it is exportable, that's probably not going to be the best use of your resources, and that you have, as you look with some of the techniques we've developed of the product space and so on, there are many things that can deploy capital and generate jobs much more readily and more profitably than replicating that experience. In Venezuela, we also tried to develop a petrochemical industry. We subsidized it like crazy. It's super capital intensive, generates 5 jobs, and we lost our shirt doing it. There are plenty of other opportunities that are potentially much more exciting, and that I think that a good example is Dubai. Dubai is a country that ran out of oil. Eventually, they're still part of the UAE, and it's not that they don't get any oil revenues, but they found a diversification strategy that based on their strength, because they were rich, they had good infrastructure and good amenities, etc. Then they used that infrastructure and those amenities to develop logistics, tourism, ports, airports, airlines, the regional headquarters of multinational corporations, finance, etc. So they diversified not through the value chain of oil, but through the capabilities that they accumulated thanks to oil, but that allowed them to deploy those capabilities in another direction.
Thank you, sir.
Yeah.
Thank you very much to our panelists and to everyone else here. So I'm just going to hand over to Mr. Frank Wike, who will help put this together.
Thank you so much. Thank you so much. Thank you, Michael. Thank you, Professor Hausmann. Thank you, Mr. Rewane. I mean, just for a moment, I thought we were back in class at the Harvard Kennedy School. Thank you so much. I mean, great insight. And I think we couldn't have had more informed guests to really help us better understand what is happening in Nigeria. I mean, I'm going to start from our brother and our compatriot here, Mr. Rewane. And his, just a very brief summary. We're going to ultimately articulate a position paper on the conversation that has taken place today, which we're going to circulate to our to the people who have been kind enough to join us. But what I hear is that Mr. Rewane is of the opinion that in order for us to begin to revive our economy, we must adopt an investment-led strategy. And he's also talking about the importance of commissioning these roads to free up funds and really give the private sector an opportunity to participate fully, given the paucity of funds at the national level. He also spoke about our airports and our seaports, and of course, the hope is that the private sector will be more expert or bring more expertise in trying to really in managing these infrastructure. He spoke about the importance of running an open economy, and of course, the issue of a convertible currency. If I had a chance to ask a question, I'll have just reminded, of course, that under Professor Soludo, way back at the time after the consolidation of the banks, the next logical step was going to be the issue of this convertible currency. You remember, even at that point, we had achieved some exchange convergence, and everybody was happy for it. But again, sentiments, all sorts of ideas, all sorts of suggestions came into it, and then we lost that great opportunity. Of course, forever, I know that both the Presidential Economic Advisory Council and at various fora, I know that, economists of integrity like yourself and your colleagues, you've all been advocating the need to remove this subsidy from our national life, at least from the oil sector. And having said that, Professor Hausmann saying, look, that Nigeria has no future unless we can actually diversify our revenue sources. He made mention of the role of the diaspora in economic development and gave examples of countries that have taken great advantage of the knowledge of their diaspora, their access to technology, their access to resources, and the expertise that they have acquired over the years, and how they've leveraged these collective features to really improve their national economies. He also spoke about the fact that one of the constraints to our inability to export is because we don't have the knowledge that is required. And he said we could acquire this knowledge if we would only allow people to come into our country, people who have the skills, who have the expertise. Not only would they be coming with their expertise, they may also be coming with even the resources that are required. And he also spoke about the importance of infrastructure and the need for us to provide efficient public goods and services. He spoke about our roads, our rails, electricity, and then issues around security is so critical. And then a very important point he made was the fact that, look, it is broken governments that actually drive away investment and drive away people who might want to come to the country, and not the kinds of issues that perhaps our governments have been looking at too. And then something again that I know I would have really loved to get additional perspectives, but I think we can do this offline shortly, is the issue of the low tax income in Nigeria. And I'm a little surprised, given the high poverty rates in the country, given the high unemployment rates in the country, given the high inflation, really, I think it presents a major challenge. And of course, people, if you look at the chat room, you find that there were copious comments on the trust deficit between the citizens and the government. And of course, last but not the least is the issues around beneficiation. Of course, listening to your last comment about Dubai and how they took advantage of the running out of oil, and how they've been able to really turn that place into a major trading route, a major tourist center, and a center of logistics in the region is just wonderful. So thank you so very much, everyone. We appreciate all of you. And the Harvard Kennedy School of Harvard Kennedy School Alumni Association of Nigeria will continue to catalyze debate on important public issues. And we do invite you to continue to partner with us to really ensure that we put we make our voices heard, we put our thoughts out there, and of course, the benefit of the expert advice and opinion of people like Professor Ricardo Hausmann, of people like Mr. Bismark Rewane, and of course, our dear brother, Michael Famaruti, Chief Economist at Steers Data. Thank you so much. Enjoy the rest of your day, and God bless you all.
Hi, my name is Innocent Isicheye. On behalf of the Harvard Kennedy School Association, Alumni Association of Nigeria, as our president just mentioned, we would sincerely like to express our sincere appreciation to Professor Hausmann, Mr. Bismark Rewane, and our moderator, Mr. Michael Famaruti, for their very, very valuable contributions to the panel discussion on enabling faster growth of Nigeria's economy. Our deepest gratitude also goes to all those who took time to participate in this webinar and who have helped to make it a truly interactive session, the questions and comments you posed to the speakers. The presentations by the speakers, as well as some of the insights and questions the audience provided, would help to shape policy paper, as our president noted, by our alumni association that is geared towards supporting greater growth of the Nigerian economy. We'd like to urge each and every one of you to follow our website, as well as our social media handles, to know more about our alumni organization and our upcoming programs. For those of you who would like to watch the session again, the recordings will be presented on our YouTube channel. Thanks once again, and we look forward to having you at our next event. Thanks.
Thank you, Thank you so much.
Thank you very much.